Many businesses that have been in existence for decades are closing shops due to the effect of the COVID-19 issues. Russia is invading Ukraine, and there are talks about possibilities of it leading to World War III. Undoubtedly, these are uncertain times, and it can really get scary for both newbie and experienced investors to decide on the best way to invest and secure their money. However, certain individuals have had the experience of investing through the thick and thin of things and have thrived despite going through uncertain times greater than the one we're currently experiencing. These individuals can give you invaluable advice on how you should invest your money in a time like this. One of those individuals is the godfather of investment himself, Warren Buffett, who still remains one of the richest men in the world after so many decades of ups and downs in the financial market. And in today's video, we will fill you in on the best strategies Warren Buffett thinks everyone should use when investing this year and the next. So prepare to take some notes, and make sure to subscribe to our channel if you haven't, and click the bell icon to avoid missing new content. Done that? Cool. Let's get right into it. Popularly known as the world's best investor, Warren Buffett took over Berkshire Hathaway in 1965, and since then, the company has never been the same. He succeeded in getting the company to generate greater than average returns on their investments every year, and he's done that by following a set of laid-down rules that were summarized perfectly by the Berkshire Hathaway vice chairman and the investor's longtime business partner, Charlie Munger. Here are the rules. The first rule: only invest in businesses that deal and focus on things that you're capable of understanding. Rule number 2 says the business has to have some essential features that serve as a durable and lasting competitive advantage. Rule number 3: the business must have a management team with enough talent and integrity to withstand human errors when they can happen. And last but not least, the fourth rule says, no matter how amazing it is, it must be a business you can buy at a reasonable price when the need arises. These are the 4 basic principles everyone should follow when making a decision to invest or not to invest in a company. No matter how the market goes, no matter the years that go by, these 4 pillars of investment will always remain the same. However, there's no doubt that there are some additional factors to consider when investing in recent times. For example, we're currently facing overvalued stock markets. Inflation is getting quite hot, and there's a high probability that we will see some hikes in interest rates this year because of that inflation. So, let's get into Warren Buffett's advice on each of these 3 factors. Let's start with the problem of overvalued stock markets. You might wonder how to start investing this year when everything is extremely expensive. If you're an active investor, there's a high possibility that you might not get many opportunities to purchase undervalued stock within your circle of competence this year. Warren Buffett commented on this issue back in 2019 in his yearly letter to the shareholders. He said, quote, "In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects now." End quote. He might be referring to buying whole businesses while you plan on buying the shares, but it's the same thing at the end. He might have struggled to figure out what to put his money into in the past year, but one thing is for sure: he doesn't waste his money on the overvalued stock. Instead, he continues to gain more income, accumulate his money, and patiently waits for the right time. Always remember that you don't make money when you sell or buy. You make money while you patiently wait for the right opportunities to come by. So do not get drawn into buying mediocre investments in an overly valued market. According to Warren Buffett, you don't need to have so many great stocks. Investing in 3 amazing businesses alone is more than enough to get you great returns that will afford you your retirement. So, All you have to do is wait patiently for the market to offer you great opportunities eventually. This is the reality of active investing this year and the next. Warren Buffett also recommends another form of investing called passive investing, which simply means you make an investment for the long haul, the buy and hold mentality. As a passive investor, one piece of advice Warren Buffett thinks will serve you well is to stick to your strategy without being swerved around by the daily happenings in the world's economy. No worrying about how high or low the market is. No focusing on news headlines. Just keep going and stick to your strategy. Have a long-term mindset. Which brings us to the issue of inflation. The United States' annual inflation is up 6.8% compared to a year ago. So, no surprise if inflation ends up being a big topic that keeps investors awake at night this year. So, what does Buffett think about investing against inflation? Well, you will get the idea by looking at how he dealt with a similar situation. Back in 1982, when the US inflation was cooling down after a massive rise, Buffett wrote in his yearly letter to shareholders what kind of businesses he should be buying during inflationary periods like this. He said, quote, "Such favored businesses must have two characteristics. 1. An ability to increase prices rather easily even when product demand is flat, and capacity is not fully utilized without the fear of significant loss of either market share or unit volume. And 2. An ability to accommodate large dollar volume increases in business, which must be produced by inflation rather than real growth, with only a minor additional investment of capital," end quote. Let's break it down for you. On the first one, Buffett is talking about businesses that have the ability to increase their prices and suffer no consequences, which surely aids in countering the effects of inflation. But what kind of business could increase its prices substantially and not lose buyers? That's where having a substantial competitive advantage comes in. Let's take the Coca-Cola Company as a prime example. They increase the price of their products all the time, but they don't lose market share. So the most important thing during inflationary periods is to ensure the companies you're looking to invest in have a competitive advantage, meaning they keep their buyers even if they increase their prices. On the second one, Warren Buffett advises investors to search for businesses that can take a large dollar volume increase with only a little additional investment of capital, so that companies can generate a lot of income without needing to spend too much to make it happen. This means that you have to search for companies with very scalable business models worth investing in. For example, Facebook doesn't need to create another app to make more income, but Ford would have to hire more employees to manufacture more cars. It's more difficult. In essence, Warren Buffett advises that you need to search for a company with a competitive advantage in times of inflation, and equally search for easily scalable companies. Lastly, let's talk about the hike in interest rates. At a shareholder meeting in mid-2021, Buffett spoke about interest rates. He said, quote, "Interest rates basically are to the value of assets what gravity is to matter essentially. So you've had this incredible reduction in the so-called super risk-free group, the short-term treasury bill, and that is the yardstick against which other values are measured. I mean, if I could reduce gravity, it's pulled by about 80%. I mean, I'd be in the Tokyo Olympics jumping, and essentially if interest rates were 10% valuations are much so, you'd have this incredible change in the valuation of everything that produces money because the risk-free rates produce nothing." Breaking it down for you, Warren Buffett explains why the market is extremely high right now. It's because interest rates are near zero, and the big managers aren't getting a return in bonds. So, the money they would have normally had in bonds gets into the stock market to chase after returns, thereby pushing up variations. Buffett was trying to explain that interest rates are to the stock market valuations what gravity is to matter. If gravity is reduced, it is easier to jump, but it's a lot more difficult to jump if gravity is increased. It's the same thing with the stock market at the moment. We see very low interest rates, which automatically means that there would be an easy rise in stock market valuations and a lot of cash flow into the market. However, things would be going in a different direction this year and maybe in the years to come. Valuations might come under pressure for overly valued stocks as the new bonds get better and interest rates rise, so be ready for it. What do you think about Warren Buffett's investment strategies? Would you use them to invest? Let us know what you think in the comments section below, and if you enjoyed the video, please hit the like button. Don't forget to subscribe and hit the bell icon to be notified whenever we post new content. Thanks for watching, and we'll see you next time.